Welcome, everyone. On behalf of the Jesus Film Project and Wycliffe Foundation, thank you for joining this informative and even historic presentation. We have entitled this seminar, Knowing All Your Bases Are Covered. My name is Fred West. I work at the Jesus Film Project office in Southern California, and I will be your moderator today. This presentation is a joint partnership with the Wycliffe Foundation, Ministry of Wycliffe Bible Translators, and the Jesus Film Project, which is a ministry of Campus Crusade for Christ. These organizations have worked together for many years, especially in the area of language translations. But this is the first opportunity that we've had to team up in serving the friends and financial partners of both organizations at the same time. Through the power of web technology, our presenters will explain some essential concepts: how to help you preserve your estate, how to do more for those you love, and how to help advance the ministries and organizations that you care about. Our presenters will be here in California and in Florida. There will be a question and answer time at the end of the presentation, so please submit any questions you have in the comment box on the right side of your screen. If you need to leave early or you want to show this presentation to some friends or family, you can watch it again at this same web address beginning Monday, September 24th. Now let me introduce our presenters. First of all, we have Michael Acapente, who lives in Mission Viejo, California. Michael has served for 30 years in the nonprofit arena with organizations such as Campus Crusade for Christ, the Salvation Army, and he's currently a gift planning advisor at the Wycliffe Foundation. Michael graduated from UCLA with degrees in business and economics, and he also holds a master's degree in taxation from Southern California University of Southern California. Scott Talbot has worked in planned giving for 14 years. The last 7 years, he's been working with the Great Commission Foundation of Campus Crusade, working especially with Jesus Film Ministry Partners. Scott's a Bible college graduate. He also holds a master's degree of divinity, and he's a certified financial planner and a chartered advisor in philanthropy. Both Michael and Scott have served hundreds of friends of the organizations that they have represented. Now, let me turn the presentation over to Scott Talbot. Scott?
Well, thank you, Fred. We're excited to be with you today. Michael and I are thrilled about the opportunity to share with you today. And we welcome each person who has joined us on today's webinar. We trust this will be a blessing to you and your families. So what are we talking about today? We're discussing the topic of estate planning. Estate planning being the process by which we put in place a plan that we have thought through and have formalized with the proper documentation, basically determining what's going to happen to our assets, how they will be distributed and managed after our death. We're talking about things like wills and trusts, and for planning at the time of death. Now, for a Christian, the estate planning process should be spiritual before it becomes mechanical. And what we do is should be based on scriptural principles. That should be the foundation of what we do. So let's take a look at a few verses from Scripture and set a foundation for our discussion today. First of all, it's important to understand that all that we have comes from God. And the book of James tells us this. James 1:17, every good and perfect gift is from above. So everything we have has come from God. Not only that, all that we have belongs to God. Psalm 24:1 tells us, the earth is the Lord's and all that is in it. There's an interesting passage in Deuteronomy 8, verses 17 and 18 that says, you may say to yourself, my power and the strength of my hands have produced this wealth for me. But remember the Lord your God, for it is He who gives you the ability to produce wealth. So even the paycheck that we earn is still something that has come from God, and it's still something that belongs to God. So what does that mean for us as Christians? That means as we approach the estate planning process, we approach it not as owners, but rather as stewards of property which belongs to somebody else, which belongs to God. That gives us not only a responsibility, but also a privilege to leverage God's resources for God's purposes and for God's agenda. So that should flavor everything that we do, and the exciting thing about that is that it makes the estate planning process a spiritual exercise and a way to engage with God. So let's take a look at some of the reasons why it's important to plan. If you don't plan, there are a number of things that will likely happen, and these are consequences that you want to try to avoid. The first thing is unnecessary costs. Without proper planning, there are costs which are actually optional costs that your family would end up incurring. Costs such as probate expenses, estate taxes, taxes on retirement plan assets. Some of these things can easily be dealt with, minimized, or even eliminated completely with the proper type of planning. Another consequence of not planning is that your assets will be distributed probably in a way that does not coincide with your wishes. If you don't have a will, the state in which you live has a will for you. They've got a formula that determines where that money, where that property will go. Chances are it's not where you would want it to go. A third consequence of not planning is red tape, just the complexity of settling your estate. Anyone who's worked with a family member, maybe a parent or another loved one, and has seen firsthand the challenges involved in settling one's estate understands that it is difficult, it is challenging, it is a bit complicated. This is something you can minimize for the benefit of your family with proper planning. Another issue is family conflicts. It's when someone dies, it's the circumstances are right for the children to be at odds with one another, and various circumstances might lend themselves to that. You want to do as much as you can to protect your children from those interpersonal conflicts, to minimize the negative impact that might be realized, and to maximize the positive impact that you can make on your loved ones and the world that you leave behind. What about children? If you have minor children, one of the significant issues when it comes to planning is if you don't put a plan together and decide on the guardian for your children, the state will choose that guardian for you. Now, do you want the state to decide who is going to be the substitute parent for your children if God takes you home early? That, for my wife and me, was the primary motivating factor for our first will. When we finally got around to doing something, we had next to nothing to our name as far as property or dollars and cents, but we knew we needed to make sure we made a good decision when it came to choosing a guardian for our son. And then finally, another issue with not planning is very simply missing out on opportunities that you have to maximize God's resources for the benefit of your family and the ministries that He leaves on your that He puts on your heart. What happens if you do plan? If you do plan, several things will happen. You have the opportunity to achieve greater efficiency in the planning process. We talked about probate expenses and estate taxes and retirement plan taxes and other expenses that are optional. With proper planning, you can minimize these costs and get more dollars to work for the benefit of your family and your ministries. Another benefit of planning is very simply that your wishes will be honored. As you pray and ask God for wisdom to help you with the decision-making process and to guide you with those distribution wishes, you'll be able to take what God lays on your heart and clearly express them in your plan to make sure that that money, that property, those resources get to the place you want them to go. Proper planning can result in greater simplicity. Again, very simply, avoiding probate, for example, can help to simplify the process and streamline things for the benefit of your family. Greater harmony. Again, looking for ways to minimize those potential interpersonal conflicts among family members and maximizing the opportunities to have a positive impact. If you plan, you get to choose the guardian that you decide is the best choice. Another benefit are the rewards of wise stewardship. As Christians who have been entrusted with God's property, what better reward could we receive than to meet the Master and to hear him say to us, "Well done, good and faithful servant." And then finally, very simply, planning is a duty accomplished. I'm not going to ask for a raise of hands, but I wouldn't be able to see your hand anyway. But if I were to ask those in the audience today, how many of you have a will? Or if you have a will, how long has it been since you've updated it? Is it current? Does it accurately reflect your wishes? Most of us don't have a plan that we'd be comfortable with if we were to die tomorrow. And yet, if you're like most people, this is something that's been on your mind, you've been thinking about it, it might even be on your to-do list. You just need to get this done. I would say do it. Go for it. Get it done. You fulfilled that responsibility. You can cross it off your list. Michael, why don't you take it from there?
Thank you, Scott, and thank you for setting the foundation, which is really spiritual in what we do here. What I'd like to now talk about is what we call the gift and estate planning process, or the five P's, which are priorities, people, property, plans, and planners. And let me move forward and just describe these 5 steps in a bit more detail. The first P is priorities. This is really, before we get into the techniques and the tools and whatnot, this is really the mission, the values. What's important to you? Why is it important? I mean, it really gets down to that. As you look at your life, as you look at your belief systems, we need to identify what you're doing and why you're doing it when it comes to estate planning. What are the things about which you're passionate about? What matters to you? Your values, your lifestyle goals. All these are important considerations, because before we can show you how, we need to know what you want to do, why you want to do it, and it really puts into context the rest of the estate planning process for you. The next P, once you've determined what you want to do and why, is people. Now, in the category of people, there are really, well, there's obviously the people in your life. They're your heirs. They could be your children, grandchildren, a family, essentially. But we also include in the category of people charity. Obviously, there are ministries of which you've been passionate about during your lifetime, and those are definitely entities that you want to consider in your estate plan. And there may be others who aren't related to you per se. Now, when we talk about your heirs and who you want to leave your estate to, some rules that we like to follow. First one is dependency. It's a biblical rule. We need to provide for those people who are dependent upon us. Now, that changes as you go through different life stages. Scott mentioned he and his wife have their kids. I have a wife and kids myself, and at this stage of my life, they're the folks who are most dependent upon me. And so a good focus of my estate plan is going to be on providing for those people who are dependent upon me. As you move through stage of life, the kids may be out. It may be grandkids. It may be someone else. The point is, whenever you think about giving a bequest to someone, make sure, first of all, they're dependent upon you as a number one priority. A second rule for our motivation for giving as we talk to people is guilt is never a good motivator. You want to give out of love. They may not be dependent upon you, but you love that person and you want to remember them in a special way. That's great. But if you're doing stuff out of guilt, that's never a good motivation. And so we would just say, consider why you're also providing a bequest for somebody. And remember the third point, people are more important than dollars. And what we mean by that is, money does funny things to people. We've all probably seen that. But the important point to think about is, as you think about the bequest you want to leave to your estate plan, what's the effect that's going to have on those persons? What's the effect it's going to have on the family dynamics? And every family's different. So it's a consideration in addition to the dollars and cents, just the whole family interactions and whatnot. And then a last question to ask, and this is a fairly simple question, but probably one that's the most difficult for many people to answer, is how much is enough? As you think about family, charities, and whatnot to whom we want to provide a bequest, a key question is how much is enough? How much is appropriate? And even beyond that, what's the most appropriate manner to leave that bequest? So this is the kind of conversation we like to have with folks when we talk about who your heirs are and things you need to think about as you go through the estate planning process. Now, that being said, let's talk a bit more about heirs, and I'm going to relate that to taxes. What do you mean taxes, Michael? When you get right down to it, taking out the cost of an estate, whatnot, there are really three potential beneficiaries of what God's entrusted to you. Obviously, people, family, friends, etc. The third is the charities, the ministries that you believe in. And that's the second. The third is the IRS. I call Uncle Sam the other heir. You don't think about him per se, but actually he wants his inheritance ahead of the first two, and he wants it 9 months in cash. So we got to keep that in mind. And we'll talk a little more about the tax laws in a moment. But the good news is that estate taxes and capital gain taxes are optional. You don't have to pay them. And that happens through proper planning and depending on your state situation and whatnot. But these are taxes you can completely avoid, and no matter how much or how little you have. Another tax, obviously, is the income tax, which with some of the techniques that we talk about, you can reduce that as well. Let's move on to the third P, which is the property. The things which God has entrusted to you. As Scott mentioned earlier, we as Christian followers of Christ, we are not the owners. We are merely the stewards of everything we have. And so a proper estate plan, we need to build a list. Okay, what has the Lord entrusted to me? Of course, there's cash like bank accounts and savings and things like that, but there are also securities, investment accounts, real estate, all kinds of real estate, from your personal home, vacation home, investment properties, businesses, a significant asset in many people's estate. In fact, statistics show that the bulk of the wealth that people own in America is really in the non-cash assets, 90%. So that's a big part of one's estate. And we can't forget the tangible property, the collectibles, which could be quite valuable. It could be jewelry, bullion, things of that nature. Bottom line, in any good estate plan, we have to gather an inventory to see what has God given to you. And not only to know what you have, but also some assets provide some unique challenges, and some assets may be better than other assets to leave to children. And so there's some unique challenges with certain types of assets. The fourth P is planning. I'm going to hand that back over to Scott to talk about the fourth P, planning.
Okay, planning. You've got your people. You've taken an inventory of your people and then your property. The next P in the process is planning. Your plans. What do you want to accomplish? What are your goals and objectives? What you do is look for opportunities to accomplish those goals using the appropriate tools. Now, in the estate planning process, let's take a look at some of the tools that might be used depending on your situation. You've got the basic tools, beginning with a will. A will is something with which most of us are familiar. It's simply the legal document that allows for the distribution of assets at the time of your death. There is also a revocable living trust, something we'll talk about in a minute here. Works a lot like a will, but with some differences. Either a will or a revocable living trust are in most cases going to be the central vehicle of one's estate plan. And then you have powers of attorney. A power of attorney deals with disability issues rather than death, but it's still something that we typically plan for at the same time, and that is choosing somebody to appoint, actually to give authority to sign your name when it comes to managing property for you in the event of your disability. And then a separate power of attorney would deal with giving authority to somebody to interact with the doctors and medical professionals in the event that you're not able to do so yourself. So you've got those tools. You've got representatives, individuals that you would need to choose to serve in various roles. You've got the personal representative, what we used to call the executor, overseeing the either your will, or the terms of your revocable living trust. You have a trustee, which, depending on the need to set up certain types of trusts, the trustee would oversee those trusts and execute the terms of that trust. And as we mentioned before, a guardian would be chosen if you have any minor children. Trusts. There are so many different types of trusts, each with different purposes, applications, objectives. Not every one applies to everyone's situation, but one or more of these might apply to you. Some of the more common trusts are a credit shelter trust, something that's also known as an AB trust. This is used for estate tax planning purposes. There's a QTIP trust, qualified terminal interest property. This is a trust that's commonly used in situations with mixed marriages, blended families, that sort of thing, and has specific applications. It may be a very basic trust set up for the benefit of the children to spread out the distribution of assets and equalize distributions among your children, and to allow for management of those funds if they are still minors. Then there are a couple of charitable trusts that we're going to talk about today with certain uses: the Charitable Remainder Trust and also the Charitable Lead Trust. There's another tool that is often overlooked or downplayed, and it's a very important tool. That's something that's called the Letter of Instructions. Most of your documentation is going to be formal wording, very carefully laid out by your attorney. It's going to be the cerebral part of your plan, the objective part. The Letter of Instructions is more the heart and soul of your plan. It has a certain subjective element. What would you use this for? A couple of examples would be to write letters to your children or family members or to loved ones that you leave behind, just communicating to them. You can include your personal testimony in your Letter of Instructions, wishes regarding your memorial service, information such as the location of important paperwork and documentation and information. Another thing that you can do with the Letter of Instructions, we talked a little bit about minimizing the potential for interpersonal conflicts among children. One place where that often arises is where it comes down to the personal effects. Those sentimental items that may not have significant dollar value, they might not be worth anything at all from a dollar and cent standpoint, but they're important to the children. And without your indicating who gets what, that could be an issue that they could end up fighting over. So the Letter of Instructions is a good place to write in what particular assets among those sentimental things, how you want those allocated and distributed. And then there's another tool that I want to make sure I mention, because this is an area where an otherwise excellent plan can fall apart, and that is thinking through your wishes, working through the planning process, getting all of your documentation down on paper. You could end up with a really good plan. But if you don't go back and make sure you've coordinated the titles of your assets, as well as the beneficiary designations on things like life insurance, retirement plans, and any annuities that you might have, your plan could fall apart. It could end up failing to accomplish what it is that you intended to accomplish. And so that's a very important last step that you need to make sure is done in the process. Let's do a case study. Let's look at a particular tool and an application for this tool, and that is the Revocable Living Trust. What is a Revocable Living Trust? How does it work? What's it for? As I mentioned before, it's an alternative to a will. A Revocable Living Trust works much the same way as a will does, but there is a significant difference, and that is it allows you to distribute your assets outside of probate. There would be no probate process. Now, what is probate? I'm glad you asked. Probate is the process by which the local courts get involved in overseeing the distribution of your assets. Very simply, they want this to the right people. And so even though there are negative implications, there are good reasons for having probate. But if you can avoid probate, there are some negatives that you can avoid in the process as well. Things like the delay of distribution of assets, the cost that's involved, probate, and settling one's estate. Typically, as a rule of thumb, 3 to 5% of your net worth is a ballpark figure. And avoiding probate would allow you to avoid about half of that cost at least. Probate is a very public thing. And if you own real estate in a state outside of your state of residence, then your estate could be subject to probate in that state as well. So there could be multiple probates. There's inventorying of property. There is, well, just the red tape that we had talked about before, cost delay, responsibilities. So if you have the opportunity to avoid probate, that might be helpful for your family in simplifying things after their death. What are some of the advantages of having a revocable living trust? Well, in addition to the fact that it avoids probate and perhaps multiple probates, it keeps your affairs private versus a will, which is a public document. It's also more difficult to challenge one's wishes when expressed through a revocable living trust. There was another thing I was going to mention too. I remember that the fact that if you move to a different state, it's portable. You can take it with you. You have the option to change it, but you don't necessarily have to. Whereas with a will, moving to another state would require that you check, review that will, make sure it coincides with that state's requirements. So that's a revocable living trust. Michael, talk to us about retirement plans.
Thanks, Scott. As Scott said, that the revocable living trust is definitely an important part to have of your estate plan. We mentioned IRAs, retirement plans, because a lot of folks have these in their estates. It's a very popular vehicle. Many people participated either in IRA, 401(k), 401s, 403s, different types of qualified retirement plans. These are great vehicles. They were set up so that the growth in income grows tax-free, and there are literally trillions of dollars in these invested in these types of plans. Now, Congress meant for these plans to be a retirement plan. They meant for you to save money and then eventually start drawing the money out so they can tax you then. They never meant these plans to be an inheritance plan or a wealth accumulation plan to pass on to your kids. And because of that, in the tax code, there are several layers of taxation that really make these plans what I call a tax time bomb in some sense if you leave them to someone other than your spouse. So, I mentioned earlier some assets are better to plan with than others. This is a particular asset we thought we'd focus on to show you how with just simple planning you can avoid some significant tax consequences and still accomplish your goals. And to demonstrate that, I'd like to show you a brief, simple case study of Mary. Before I do that, though, let me just talk about those taxes. There are several layers of taxes, as I mentioned. There's the federal estate tax, which currently is 35% and is pegged to go up to 55% at the first of the year. Some states also tax what's called an inheritance tax. Not every state, but there are several have that. That's another layer of taxation. There is the federal income tax, and there's also a state income tax. I've seen case studies where literally 80 to 90% of the IRA was taxed away before the kids or grandkids even saw one dime of it. So again, a great tax planning strategy while you're living, but a tax time bomb when you pass away. So let's look and see how we can avoid that consequence. We have the case of Mary. Has a modest $1 million estate, of which $100,000 is in an IRA. And as most people, she has named her children to be the beneficiaries of this IRA upon her passing. Her estate also has some bequests going to several charities that she wants to remember. And at this point, under the current tax code, her estate would not face any taxes, but we have the IRA in the estate. And before the children would see it, there would be a $48,000 tax on that IRA asset alone. Family still gets a nice inheritance, and of course the charity also gets a nice inheritance. But there's a better way to do this. And so a much more tax-wise option for Mary to consider would be, instead of naming her children as a beneficiary of the IRA, name the charitable benefit, the charities as the beneficiary of the IRA, and leave the other assets to the kids. Charities are tax exempt. They don't pay income taxes. And so, as you can see in the box below there, now we've completely eliminated Uncle Sam from the picture. Family has gotten more, and she still has accomplished her charitable desires to support charity. So you can see, just by simply tweaking her plan a little bit like this, we can generate tax savings and get more to the kids. And by the way, this is not hard to do. This really just takes a 1 or 2 page document. You don't even need an attorney to do that. Now you may say, that's great, Michael, but my IRA is a pretty big part of my estate, and I want to leave some of it to my kids. Is there a way I can still do that and avoid or at least minimize the taxes on that? Well, one idea is what we call a give it twice IRA. Instead of naming your children as the beneficiaries of your IRA, name something called a charitable trust. And then you can, in the design of the trust, you can decide how much the children will get and for how long. For example, in this illustration, we say, let's pay the kids 5% income over 20 years. So in a sense, what we're doing is spreading out their inheritance over time, which may not be a bad thing in its own right. And at the end of 20 years, after the income has been paid to the kids, they have that amount. Then the remaining principal goes to one or more ministries that you've named to be the beneficiary of the trust at the end of the term. So these are just a couple of simple planning tools to show you how, with an asset that's a big part of many people's estates, how with some simple planning and adjusting of your estate plan, we can help you save on taxes, still provide for your children, and still provide significant gifts for one or more of your favorite ministries. There's some other tax planning devices. I'd like to hand it back over to Scott to talk about those.
Thanks, Michael. That's good stuff, what you just talked about. I have to say that the giving it twice IRA concept has clicked with so many people with whom I've spoken. It's just an idea that a lot of people really love. Makes a lot of sense. The taxes on retirement plan assets are a very common tax that most everyone faces. The tax that I'm going to talk about now, the estate tax, may not affect as many people. It may not affect those of you who are listening, but it's important to go over it and understand it, because if this does apply to you, it's a significant tax. And yet there are ways to avoid it. So let's talk about the estate tax, and then we'll bring in the charitable lead trust. How do estate taxes work? The IRS says that when we die, we are taxed on the privilege of giving away our property. The rate of tax is 35%. At least that's what it is for this year. But it's not taxed on the first dollar. The first $5 million of assets, it's a little over $5 million, $5,120,000. That's called an estate tax exclusion, and that means the first $5 million or so we can give away, and there's no tax on that. It's just a tax on the estate, the value of the estate over that $5 million figure. So everything over $5 million would be taxed at 35%. However, the future is uncertain, because there are tax law changes that are going to take place as early as next year. In fact, Congress doesn't even know yet what the tax law is going to be for next year when it comes to estate taxes. It could be about the same as what it is now, could be a little bit lower. There's a good chance that it could actually go down to as low as $1 million, where it had been a few years ago. And the tax would increase from 35% to 55%. So all of a sudden, $1 million is a little bit closer to home for some of us. In fact, if you include the death benefit, the face value of any life insurance that you own, even if it's term insurance, that all becomes part of the calculation for determining your net worth and whether or not there's an estate tax for you. So all of a sudden, more of us are sucked into this situation, the estate tax liability, making it more important for us to consider our planning alternatives. So if this is your situation, or somebody that you know is subject to estate taxes, what are some of the first steps that would normally be taken to minimize or avoid the estate tax? One is very simple. That would be giving away during your lifetime to family members, to charity, what you didn't need to keep for yourself for later. In other words, if you can afford to give some away during lifetime, then do that. That's going to keep your estate from being that much larger and having that much more estate tax liability. Another strategy is to take any life insurance that you own and take it out of your name for ownership purposes. You can keep the life insurance. You can keep the death benefit the same. What you need to do, though, is change ownership. And what makes sense in some situations is setting up an ILIT, what we call an irrevocable life insurance trust, that would own the policy for you. If you have life insurance and you're subject to estate taxes, this is a very easy and important step to take to really avoid a lot of that liability. You've got an AB trust or a credit shelter trust. Without going into a lot of detail, this very simply allows a married couple to basically double the exclusion amount. So both husband and wife get to use that, whether it's the $5 million exclusion, $1 million, whatever. You're doubling that exclusion for the benefit of the couple. There are deductions, I should say, for any charitable donations made out of your estate. In other words, whatever goes to charity is subtracted dollar for dollar from your estate value when calculating the estate tax. And so if you've got charities included, that's going to help you from an estate tax standpoint. But let's assume you've taken some of these first steps and there's still a considerable portion of your estate that will be subject to estate taxes. You haven't eliminated all of that yet. Is there something else that can be done to deal with this? And the answer is yes. The Charitable Lead Trust is an ideal tool for solving this problem. With a Charitable Lead Trust, you can take an estate of any size and avoid every penny of the estate taxes. How would it work? What you would need to do is take that portion of your estate, that amount that would be over the limit that you haven't already sheltered in other ways. Take that and put it into a Charitable Lead Trust. Charitable Lead Trust is simply a trust that would be drafted with the help of your attorney, and it would pay an income stream. The trust would pay an income stream to one or more charities that you choose for a period of years. If the percentage payout and the period of years are appropriate, you can kind of mix and match higher payout, shorter number of years, etc. But if you use the appropriate payout period and percentage, what's going to happen is that income stream to charity is going to create a tax deduction that in essence is going to zero out any estate taxes on that property. At the end of the period, then, the property or money in the Charitable Lead Trust would revert to your children, allowing them to get even more, the full value of your estate without any erosion due to estate taxes. Michael?
Thanks, Scott. Well, we just shared you some of the few of the tools that people can use as they accomplish their plans. Now, you may say, that sounds great, Scott, Michael, but my plans are in order. And we hear that often, and truly we hope that your plans are in order, but there's some questions that we think are important to ask when you think your plans are in order. First of all, it's been our experience that many people think that estate planning is a one and done. They've done the estate plan, it's done, it's there in the bookcase or in the safety deposit box, wherever you keep your important papers, and you've done it. But as we all know, life moves on, life changes, and we all experience significant life changes. And so that's one of the first questions I would ask is to say, you know, have you experienced significant life changes since you last did your estate plan? Has there been a birth of a child or a grandchild or the death of somebody? Have there been marriages, divorces? Have you sold a business? Are you retired? A lot of changes happen in life, and as you move to those stages of life, your estate plan truly should be updated to reflect those. I'll give you an example. When my wife Wendy and I had our youngest, Luke, about 4.5 years ago, soon after he was born, one of the things we immediately did was we went and saw our attorney and said, we have a new addition to the household. We need to modify our trust to account for that. And I know my parents and their estate plans did likewise. So, again, if you have made a trust or a will, if you had changes in your life, it's definitely something you ought to review. We've talked a bit about estate tax laws, and the laws, as Scott said, we don't know what, even Congress is not sure what the law is going to be next year. But there could be some significant changes in the estate tax laws, and as we showed you previously, we want to make sure we're good stewards. We want to make sure you minimize that which you're sending Uncle Sam and maximize that which you're sending to family and charity. And so that's another good reason to review your estate documents. We have heirs who have different abilities to handle wealth. I think of the story of the prodigal son. I know Jesus had other reasons for that story, but that's an estate plan gone bad. One of the sons got too much too soon, and it did not help him, did not help the family matters, the relations. Sometimes you want to provide for those kids that are dependent upon you, but if their ability to handle wealth is not the most mature, let's say, there are things you can do in your estate plan to still provide for them, but avoid any spendthrifts. We talked potentially about tax impacts. I won't go into that too much, other than to say if you have major assets you're thinking of selling right now, your capital asset like real estate or a business, there's some planning you can do ahead of time to minimize or avoid taxes, which also affect your estate long term. Some other reasons to consider reviewing your plans also include, we've talked a lot about how stewardship is really a spiritual process, and from the whole spiritual perspective, does your estate plan really reflect your kingdom and personal goals? And what impact is your plan going to have on the kingdom and God's kingdom? So something very important, is it in alignment with that? We've already talked about this again, but I'll say it again. When's the last time you reviewed your plans? Earlier this week, I was speaking with a lady who said my plans are in order, and I asked the question, well, when's the last time you updated them? Well, it was in 1999. Some things have changed since 1999, and we're going to visit those again. Did you get counsel from a stewardship perspective? Many financial advisors, attorneys are very good at what they do, but they don't even consider the whole spiritual and stewardship perspective of estate planning. And it's more mechanical. And we think it's of great value to say, Lord, this is your assets from a spiritual perspective, from a biblical stewardship perspective. How do my estate plans line up with that? And how can I adjust them to make sure they line up with what you want us to do with this, God? And for the last reason, it cannot hurt to have a free second look. We'll talk a bit more about this in a moment, but Proverbs talks about, with many advisors, there's great wisdom, and so sometimes getting a free second look, there are things that we may find in estate plans that other people have overlooked, and it's worth considering. Well, how can we help? Both Scott and I, we look at our calling as a ministry to our partners and donors for Jesus Film and for Wycliffe. We're here to serve you. This is a ministry that we provide, that Wycliffe and Jesus Film Campus Crusade think it's important, and so we're here to serve you. We provide private consultations and estate plan reviews that are completely confidential and completely free of any cost or obligation. We also believe it's important to work with your advisors, the people whom you trust, whether it's your accountant, CPA, financial planner. That's the fifth P, by the way, your planners. And we also, and I think this is important because we sometimes hear this, we understand that people have multiple charitable interests. My wife, Wendy, and I support several charities, including Wycliffe, our church, Campus Crusade, and others. And so when we meet with people, we may have Wycliffe on our shirt or the Jesus Film on our shirt, but we understand you have more than one charitable interest typically, and we're fine with that. We want to work with you to make sure that your plans and that are in alignment with where you think God wants you to direct your assets. I'd like to turn over to Scott now. We'll talk about just the planning team.
Well, one of the things that we were not aiming to do on today's webinar is to make you an expert on estate planning. And in a brief hour's time, we've just scratched the surface on what the process involves and how it can benefit you. One of the things that you may have come away with today is the fact that estate planning is not a do-it-yourself process. It's something that, to be a wise steward, you need helpers. You need professional advisors to guide you through the process. There are folks such as attorneys that we've mentioned that obviously play an important role, provide counsel to you and draft the necessary legal documents. For many, a good CPA would be helpful, as well as other types of financial planners. What about us? Why include us on your team? You might have some of these professional advisors in place already, and you might be wondering, why would it be important to include us as well? Well, we believe that we're a valuable part of the team, and we have a unique set of skills and insights that we bring to the table as well. We're not looking to replace anyone on your team, but to supplement what you're getting from other advisors. So we would offer that to you to serve with your other professional advisors for your benefit. Why include us? As Michael mentioned, there is no cost. We're not going to send you a bill. There's also no pressure. We never tell anyone where to give or how much to give. We're getting on your side of the table, trying to understand your goals and objectives and laying out opportunities and options for you to work through to that end. We have no hidden agenda. Further, you're getting help from friends that you know and trust. Many of you on this webinar today are very familiar with either Wycliffe or Campus Crusade for Christ, perhaps even the Jesus Film Project in particular, maybe both of these ministries you're involved with, and perhaps for some time. And so you're a ministry partner. We're part of the same family. And to be able to work with friends that you know and trust is a good thing. Additionally, including us on your team will help you to understand all of your options. I think one of the biggest things that people miss out on without our input is very simply they can end up with a really good plan, but I think it's those opportunities that they weren't presented and generally would not be presented with that they would have a chance to consider and weigh out. Is this a tool, a concept, a strategy that would better help me to achieve what I feel God leading me to do? And in the end, ultimately, our goal is in working with you and helping you to know that all of your bases indeed are covered. So I'll turn it back to you, Fred.
I'll turn my mic on. Thank you both, gentlemen, for your insightful thoughts and presentation. In light of the economy, the past 4 years, and the potential for higher taxes in the future, it prompts me to want to pull out our documents. In fact, yesterday my wife pulled out our documents, and we're going to review those documents in the near future. Now, if you have a question, we would appreciate it if you would submit it at this time in your comment box to the right of the screen, and let us know what your thoughts are. Again, this seminar will be rebroadcast by going to the same web address that you're on right now, and you can watch it with some friends or family members at any time beginning Monday. Well, here's a question. I think you addressed it to some extent in your presentation, but why would I need your help if I already have an attorney, a CPA, a financial planner, a banker, and all these other people helping me? Scott, can you comment on that?
Yeah, I'd love to. Each professional advisor has his own area of expertise, his own focus, his own field of specialty. The attorney does, the accountant, the financial planner, the insurance professional, the investment professional, whoever it might be, they have a specific skill set that they're bringing to the process. We do as well. While there are areas of overlap among pretty much all of the planners that are involved, there are distinct strengths that they bring to the table. Our area of strength is in Bible-based stewardship counseling and in charitable plan giving techniques for those that care about that, showing them ways to be more efficient and effective in funding the ministries God lays on their heart, whilst actually helping them to find the money to do that in the process. So I hope that helps to answer the question.
All right. Thank you very much. Anything you want to add to that, Michael?
No, I think Scott covered that well.
Okay. It's just that you carry some specific expertise that most attorneys and CPAs don't take into consideration. Okay. Another question here. 2 of our 3 properties are referenced in our trust. Does our trust need to be updated each time we buy or sell a property? Michael?
No, not necessarily. When you buy real estate, it's more of a titling issue. And the idea is you want to typically name the deed of the property and the title of your trust. So you don't have to update your trust every time. It's more updating the deed to the property. As I mentioned previously, typically we talk about updating your trust when, well, it's been a while since you've looked at it, or its provisions are not in alignment with your current situation in life. But again, to answer the first question, no, the trust typically does not need to be updated because it's more of an issue of legal title than anything.
Thank you again. Here's another question. We moved from California to Arizona in 2007. Is it necessary to update or make changes to our living trust? Michael, you want to take that?
No, okay. I would say yes, especially this trust is a permanent move. Every state, as Scott described earlier, has probate process and statutes and whatnot, and not every state's the same. So I would definitely, at the very least, once you're established in Arizona, find a good qualified estate planning attorney, one whose focus of the practice is in estate planning, and have him or her review the trust to make sure that its provisions are correct and in alignment with, in this case, Arizona law.
Thank you again, Michael. Here's a fresh question that we've had sent in. I would encourage people to have their revocable living trust reviewed and potentially updated, amended, or restated upon relocation to a new state, just like the suggestion for a will. So it's just a statement more than a question, but do we have any other questions? If you'd like to ask a question, we still can accept them at this point. Notice the information on your screen. You can contact Michael or Scott directly with their toll-free telephone numbers or by email. They would love to hear from you. And please let us know if there's anything else we can do. Well, Michael, I have a question myself. How can I'm particularly concerned about these IRAs that I'm going to be taxed heavily on. How can what specifically do I need to do? Do I need to change the beneficiary? We have a revocable living trust. Can we change the beneficiary to the trust itself?
Usually it's not advisable to name a trust as the beneficiary of your IRA because there's tax complications that can happen there. The IRA, you can simply have what's called a beneficiary designation form. And with that beneficiary designation form, you can name whatever beneficiaries and whatever allocations you want. And so that's usually the best place to accomplish that versus having your trust be named as a beneficiary.
Stay on for one more, if you want to have one more question, okay? All right, we got that. Thank you very much. This will be the formal completion of our presentation. If you need to drop off, that's fine. We have a couple of more questions that have come in. If you'd like to stay around and listen to these questions, we will be happy to have you stay on the line. Okay, here's a question about precious metals. How could precious metals that are owned personally be addressed to minimize tax and probate? Any thoughts on that, Scott?
Sure. Well, let's talk about during lifetime. Whether it's precious metals, stocks, real estate, business ownership, there are many assets that when they appreciate in value and then we go to sell those assets, we end up having to pay taxes on the gain, the capital gains taxes to which Michael referred several times. Capital gains taxes are optional, and there are several different ways to approach that in the planning process. The best thing to keep in mind is that when it comes time to sell an asset like that, give Michael or me a call, and we can review those planning strategies with you specifically, specific to your situation. But it's very important that the planning be done before the asset is sold, and if it's something like, for example, real estate, it should be done before the property even goes on the market. As far as after death, you asked the individual asked the question about avoiding probate. One easy way to accomplish that objective is to make sure that it's properly placed within a revocable living trust. If you have a revocable living trust, making sure that asset is titled to the trust so that it would not go through probate. Without a revocable living trust, there are ways to set up a payable on death account for a brokerage account, which is similar to naming a beneficiary, and that would also allow you to avoid probate in that process.
All right. Thank you very much. Here's another question from Bob in Florida. You mentioned that titling my assets in a living trust. Does that mean my house, my car, down to what extent, and bank accounts? What else should be included? Michael?
Typically, yes, your house will be part of the assets, including your trust. I've never really heard of a car being put into the living trust. Perhaps your checking account may be part of that living trust as well. But that would be my general answer. Sometimes a Florida attorney may have some other ideas, but typically your house is put in the car. Personal property, in my experience, more often than not, is covered through a will and or letter instructions, like to which Scott referred. Scott, what do you think?
Well, there are certain assets that you wouldn't need to put in the trust, such as life insurance, because it already avoids probate. Some people will name life insurance, name their trust as the beneficiary of the life insurance just to run everything through the trust and to simplify things, but that is optional. And as you mentioned before, IRAs are another asset that you do not want to put into a trust. In fact, you cannot. That must remain in the hands and ownership of an individual, but that also avoids probate. Most other assets can and should be titled to the trust. Household goods and personal effects are usually, because they don't have a piece of paper representing ownership, there is nothing where you can change a title, but just by mentioning in the trust that those assets, the personal effects, are included in the trust, that will hold up under law. Bottom line is, if you have the trust and you have any asset that's not titled to the trust, then you're missing out on the opportunity to avoid probate, which is the very reason that the trust was created.
So you basically need a revocable living trust and a will if you're going that direction.
The will would be kind of like the safety net to keep to catch anything that was inadvertently left out of the trust. It's called a pour-over will.
Is that also where a statement about who your assets would go to in case things change in your family? Did you make statements in the will about that?
Are you asking if you have a revocable living trust?
Yes.
The trust itself.
You have that.
Yeah, if you have a revocable living trust, that is going to be the central vehicle of your estate plan. That is the document that will govern when it comes to allocating assets, distributing property. The pour-over will, it's all it is a safety net. It's just going to catch anything that's outside of the trust, move it over into the trust. That's it.
Okay, here's one final question. Is there a minimum donation for your services? Michael?
No, there's not. We don't ask for any minimum donation. I think Scott referred to that earlier. We do this. There's no cost or obligation. This is a service and a ministry we have to offer the donors of our organizations, and so there's never an expectation of a minimal gift amount or anything like that. This is a service and a ministry we offer free of cost and free of obligation.
See, my terms are different, Fred. I wouldn't mind if they bought me a cup of coffee. That could be a good thing.
Starbucks, maybe.
Starbucks.
That could be a deal breaker.
I'm kidding.
Well, thank you, everyone, for joining and staying on the line. Again, if you want to watch this presentation or show it to someone else, please come back to this exact same web address, and you'll be able to watch it at any time. No specific time is necessary. Thank you again, and we'll be signing off right now.